Good afternoon. We are first going to discuss some housekeeping items off the record, and after that, we'll go on the record where the parties can introduce themselves. Today, oral hearing proceedings for the appeal of Liberty Mutual Group, Inc. is being conducted in person in Cerritos, California, and it is right now being recorded. Present is our stenographer, Ms. Alonzo, who is reporting this hearing verbatim. To ensure we have an accurate record, we ask that everyone speaks one at a time, does not speak over each other. Also, speak clearly and loudly. When needed, Ms. Alonzo will stop the hearing process and ask for clarification. After the hearing, Ms. Alonzo will produce the official hearing transcript, which will be available on the Office of Tax Appeals website. Please do not interrupt when someone else is speaking. Each side will have the opportunity to be heard, so please wait for when it's your turn to present your arguments. Also, I would like to remind the parties that the Office of Tax Appeals is not a court, but is an independent appeals body. The office is staffed by tax experts and is independent of the state's tax agencies. Let me first turn to respondent. Are there any questions about anything I have just said before we go on the record?
No questions, thank you.
Thank you. And turning to appellant, any questions?
No questions, thank you.
Thank you. Let me check on our stenographer to ensure we're ready to go. I see a thumbs up, so we're ready. We are opening the record in the appeal of Liberty Mutual Group, Inc. This matter is being held before the Office of Tax Appeals. The OTA case number is 211-29233. Today's date is Thursday, February 12, 2026, and the time is 1:27 p.m. This hearing is being held in person in Cerritos, California. Today's hearing is being heard by a panel of 3 administrative law judges. My name is Mike Lee, and I will be the lead judge. Judge Cheryl Aiken and Judge Kenny Gass are the other members of this tax appeals panel. All 3 judges will meet after the hearing and will produce a written opinion as equal participants. Although the lead judge will conduct the hearing, any judge on this panel may ask questions or otherwise participate to ensure we have all the information needed to decide this appeal. Now, for the parties' introductions, for the record, will the parties please state their names and who they represent, starting with respondent.
Hello, my name is Brian Beck. I am an attorney for the Franchise Tax Board, which is the respondent.
Good afternoon, Delinda Tamani, Assistant Chief Counsel for the Multi-State Tax Bureau for the Franchise Tax Board.
Thank you. And turning to appellant.
Lindsay LaCava for Appellant Liberty Mutual Insurance Group.
Maria Eberly for Appellant Liberty Mutual Insurance Group.
Dimitri Gabriella for Appellant.
Thank you. Let's move on to my minutes and orders. As discussed with the parties at a pre-hearing conference on January 16, 2026, and notated my minutes and orders, there are 2 issues in this appeal. The first is whether appellant's interest expense deduction is barred by Revenue and Taxation Code Section 24425. The second is whether the accuracy-related penalty should be abated. During the parties' presentation, the parties may provide a brief statement outlining the issues on appeal. Appellant's Exhibits 1 through 60 were entered into the record in my minutes and orders. Respondent's Exhibits A through N were also entered into the record in my minutes and orders. No witnesses will be testifying at this hearing. After the pre-hearing conference, respondent submitted a PowerPoint consisting of 2 slides. Both parties submitted a list of cases and names to the stenographer, so thank you both. This oral hearing will begin with appellant's presentation for up to 30 minutes. Before we start with appellant's presentation, I just want to check to see if there are any questions or comments. Respondent?
No questions, thank you.
And turning to appellant, any questions or comments?
No questions, thank you.
Thank you. The time right now is 1:30 p.m. Please proceed with your presentation.
Good afternoon. May it please the court, my name is Lindsay LaCava, counsel for appellant, Liberty Mutual Group, which I will refer to as Liberty Mutual. Quite simply, there are two reasons why Section 24425 of the Revenue and Taxation Code cannot apply, in this case, to disallow the deductions taken by Liberty Mutual for insurance expenses and losses on the extinguishment of debt where Liberty Mutual contributed those borrowed funds to its insurance subsidiaries. First, the expenses at issue are only potentially allocable to Liberty Mutual's dividend income from its subsidiaries. And second, that dividend income is included in the measure of Liberty Mutual's corporation franchise tax. The way the Franchise Tax Board has interpreted and applied Section 24425 in this case is simply incorrect. The core facts here are not in dispute. Liberty Mutual owns a group of insurance and non-insurance subsidiaries. For each of the tax years at issue, Liberty Mutual was subject to corporation franchise tax and filed using the combined reporting method that included certain of its unitary affiliates. Liberty Mutual's insurance subsidiaries were properly excluded from its combined California returns because those insurance subsidiaries were subject to and paid California's gross premium tax in lieu of the corporation franchise tax. This case centers around interest expenses and losses on the extinguishment of debt, which I will collectively refer to as interest expenses for ease, that were incurred by Liberty Mutual during the years at issue. After several concessions by the FTB during the briefing process, the interest expenses that remain at issue in this case relate to 7 debt issuances and tender offers that were made by Liberty Mutual to unrelated third parties. Liberty Mutual used all or a portion of those debt proceeds to make capital contributions to certain of its insurance subsidiaries. Each of these debt transactions, the use of funds, and the related disallowed interest expense amounts are all summarized and spelled out in Appendix 1 of Appellant's reply brief that was filed on February 20th, 2023. Throughout the tax years at issue, Liberty Mutual received a return on its investment in its insurance subsidiaries in the form of dividends, which Liberty Mutual included in the measure of its corporation franchise tax as reflected on line 4 of Schedule F of Liberty Mutual's California returns. During the period at issue, Liberty Mutual properly deducted the interest expenses at issue for federal income tax purposes under Internal Revenue Code 163, and by virtue of California's conformity to the Internal Revenue Code, Liberty Mutual also deducted the interest expenses at issue for corporation franchise tax purposes. The Franchise Tax Board in this matter has incorrectly asserted that the deductions taken by Liberty Mutual for the interest expenses at issue should be disallowed under subsection A of 24425. So I will turn now to the statutory structure and focus on the proper reading and application of section 24425A. And since we've lost our demonstrative on the screen, hopefully everyone has it in front of them. I will read the relevant part, which is that no deduction shall be allowed for any amount otherwise allowable as a deduction, which is allocable to one or more classes of income not included in the measure of this part, with this part referring to the California Corporation Franchise Tax Act. The deductions at issue here are the interest expenses related to the debt proceeds that were contributed to Liberty Mutual's insurance subsidiaries. And this case turns on the proper application of the phrase allocable to one or more classes of income not included in the measure of tax. So let's start with the words class of income. The relevant class of income here is Liberty Mutual's dividend income. As a threshold matter, the class of income to which expenses may be allocable must be income of the same taxpayer who is claiming the deduction. This is mandated by the overarching statutory structure of the California Corporation Franchise Tax, which computes and imposes tax on each taxpayer separately. and thus the statutory phrase class of income included in the measure of the tax necessarily refers to a class of income included in the taxpayer's measure of corporation franchise tax. Decades of prior case law also confirms that the relevant class of income must be income of the same taxpayer seeking to take the deduction. Indeed, every single case concerning Section 24425 that was cited by both appellants and respondents in the hundreds of pages of briefing in this case, the class of income at issue was always a class of income of the same taxpayer claiming the deduction. This is also consistent with the purpose and intent of Section 24425, which is to prevent a taxpayer from receiving a double benefit. Given this framework, the only relevant class of income to which the interest expenses can potentially be allocable is the dividend income earned by Liberty Mutual as a result of its investments of the debt proceeds in its insurance subsidiaries. In fact, the FTB itself previously agreed with this view in its determination letter issued in the FTB appeals process, which stated that because Liberty Mutual generates income, i.e. dividend income, that is a class of income not subject to the corporation tax law, and the interest expense paid by LMGI and other insurance company subsidiaries is not allowable as a deduction because it is allocable to that class of income, end of quote, which is included in Exhibit 17. The FTB has now asserted a different and incorrect reading of Section 24425, arguing that the class of income is somehow the insurance income of the separate insurance subsidiaries. The FTB argues that the interest expenses relate to funds that make the insurance subsidiaries, quote, capable of continuing to generate income, end quote, that is not subject to corporation tax. This is directly contrary to prior California case law, which has recognized the separateness of corporations, including in the context of Section 24425. Notably, in Great Western, the California Supreme Court held, quote, where there is more than one corporation, they are entirely separate entities for purposes of the California franchise tax. Neither Revenue and Taxation Code Section 24402 or Section 24425 purport in any way to affect the entirely distinct and self-sufficient nature of the corporations. It is a fundamental principle of tax law that each taxpayer is accountable and taxable only upon its own income and may deduct only its own expenses allocable to the earning of such income. I will repeat the key words here. Each taxpayer is accountable and taxable only upon its own income and may deduct only its own expenses allocable to the earnings of such income. Thus, the statute does not allow for the allocation of one corporation's expenses to another corporation's income for purposes of disallowing those expenses under Section 24425. If allowed to stand, the FTB's proposed interpretation would create a highly ambiguous and unworkable standard because taxpayers that borrow funds for investment purposes would have to track how investees are using those funds and whether any income generated is taxable or non-taxable to the investee. The absurdity of the FTB's position is further highlighted by Section 244 itself, as this reading would make portions of Section 24425 superfluous. For example, Section 24425B1A disallows a deduction for interest expenses paid to an affiliated insurer. Under the FTB's strained reading of 24425A, this provision would be unnecessary if the interest expenses could be allocable to the income of the insurance affiliate, which is not subject to corporation tax. Additionally, The FTB's reading would call into question whether premium expenses paid by non-insurers to insurance companies could ever be deducted, because the premium income of the insurance company is never subject to corporation tax. So in summary, the only proper and logical reading and application of the phrase class of income that is consistent with the structure of the Revenue and Taxation Code and prior precedent is that the interest expenses here are allocable to Liberty Mutual's own dividend income. Next, I will turn to the words included in the measure of the tax. Here, Liberty Mutual's dividend income, which we've established as the class of income at issue, was included in the measure of its corporation franchise tax. Liberty Mutual properly included the dividend income in the computation of its income as reflected on Schedule F, Line 4 of its California returns, which are included as Exhibits 3 and 4. The dividend income from the insurance subsidiaries did qualify for a partial 85% deduction under Section 24410, but the key word here is partial. Prior case law analyzing Section 24425 has only ever disallowed expenses that are allocable to wholly excludable or wholly eliminated income. For example, Great Western involved expenses allocated to dividends that were wholly deductible at the time, and which the court characterized as eliminated and therefore not subject to the measure of tax. Subsequent California case law, including Zenith, has similarly stated that Section 24425 applies only to expenses that produce, quote, wholly excludable income. Additionally, prior California Supreme Court and Court of Appeals cases analyzing the identical phrase included in the measure of tax in a former dividends received deduction statute also concluded that amounts that are offset by a partial deduction are indeed included in the measure of the tax. Lastly, the FTB seemingly acknowledges on page 23 of its additional brief that the recent Minnesota BEAT and non-precedential Microsoft decisions issued by this Office of Tax Appeals also support a distinction between income that is wholly eliminated versus income that is subject to a partial deduction. So in conclusion, the dividend income from the insurance subsidiaries was included in the measure of tax, notwithstanding the partially offsetting deduction, and 24425A does not apply. This analysis of the plain language of the statute is also consistent with the overarching intent of Section 24425A. The clear purpose and intent of this provision is to prevent taxpayers from receiving a double benefit. The classic example would be borrowing funds and taking interest deductions to purchase municipal bonds that then generate tax-exempt income, again, to the same taxpayer. There is no double benefit here. Liberty Mutual borrows money from third parties. It contributes the funds to its insurance subsidiaries. Liberty Mutual then earns a return on that investment in the form of a dividend, which is then subject to California corporation franchise tax. Application of Section 24425 to deny the interest expense deductions to Liberty Mutual would result in double taxation to Liberty Mutual. First, it would be taxed on its disallowed deduction for the interest payment. And second, it would be taxed on the dividend income that it then earns from its insurance subsidiaries. And this double taxation is then compounded by a third layer of taxation when the insurance affiliates pay premium tax on the income from their insurance business. Thus, the FTB's position would lead to an outcome that is directly contrary to the purpose of Section 24425. This concludes my discussion of why Section 24425 does not apply to disallow Liberty Mutual's interest expenses, And so I would like to turn now to why the imposition of an accuracy-related penalty is not appropriate in this case. As you know, penalties cannot apply when a taxpayer has substantial authority for its tax treatment. Second, when the taxpayer's position was adequately disclosed in the return and there is a reasonable basis for the tax treatment. Or, thirdly, where the taxpayer acted with reasonable cause and good faith. Penalties must be abated if any one of these elements are met, and all three elements apply to prevent the imposition of a penalty here. First, turning to substantial authority, there is substantial authority for the tax treatment of an item if the weight of the authorities supporting the taxpayer's treatment is substantial in relation to the weight of the authorities supporting contrary treatment. As outlined in my prior remarks and the hundreds of pages of briefing in this case, Liberty Mutual relied on the plain statutory language, case law, and overarching purpose of Section 24425 in determining the treatment of the interest expenses on its tax return. Importantly, a taxpayer does not need to prevail in litigation to have substantial authority. Thus, Liberty Mutual had substantial authority to deduct the interest expenses on its returns regardless of the ultimate outcome of this case. Next, turning to adequate disclosure, Liberty Mutual adequately disclosed the interest expense deductions on Schedule A of its Form 100W. Other tribunals have found that displaying a deduction on the return is sufficient disclosure under a similar standard, and I refer you to the Stewart Shops case cited in our briefs. Moreover, the reasonable basis standard is lower than the substantial authority standard that we just discussed, so is necessarily met for all the same reasons that the substantial authority standard is met. Thus, Liberty Mutual adequately disclosed its interest expense deductions on its return and had a reasonable basis for the position. Lastly, turning to reasonable cause and good faith, the penalty does not apply to any portion of an underpayment where the taxpayer acted with reasonable cause and in good faith. A reasonable cause determination takes into account all of the pertinent facts and circumstances. Here, Liberty Mutual made substantial efforts to determine its correct corporation franchise tax liability, ultimately relying on statutes, case laws, and the other authorities discussed in deducting its interest expenses. This is further demonstrated by the fact that many of the deductions that were originally denied by the FTB on audit were ultimately conceded throughout this process. Thus, Liberty Mutual had reasonable cause and acted in good faith in deducting its interest expenses. For these reasons, substantial authority, adequate disclosure and reasonable basis, and reasonable cause and good faith penalties cannot apply. So in summary, Section 24425 of the Revenue and Tax Code cannot apply to disallow the interest expense deductions at issue in this case because first, the interest expenses at issue are only allocable to Liberty Mutual's dividend income from its insurance subsidiaries, and that dividend income is included in the measure of Liberty Mutual's corporation franchise tax. This is why Liberty Mutual must prevail. And at this time, I welcome any questions that you may have.
Thank you so much for your presentation. Let me turn to the panel to see if they have any questions. Judge Aiken, any questions?
Try that again. Thank you. No questions from me at this time.
Thank you. Turning to Judge Gass, any questions?
Same, no questions at this time. Thank you.
Okay, so now it's respondent's turn. You have up to 30 minutes, we're starting at 2 p.m. Please proceed. Thank you.
2 p.m. Okay. Good afternoon. I am Brian Beck, Attorney for Respondent, Franchise Tax Board, and with me I have Delinda Tamagni, Assistant Chief Counsel of the Multi-State Tax Board. Multi-State Tax Bureau.
If you can you move your microphone a little bit closer to you?
I'm sorry.
And make sure it's turned on.
There you go. Appellant Liberty Mutual Group, Inc. borrowed funds and contributed the funds to insurance subsidiaries. The insurance subsidiaries were tax exempt. Appellant deducted the interest expense. Because Revenue and Taxation Code, RNTC, Section 24425, disallows double tax benefits, respondent disallowed the expense deduction. Appellant has not established entitlement to this interest expense deduction, and therefore, respondent's disallowance was proper. There are two issues. The first issue is, has appellant shown that it is entitled to the identified interest expense deductions after application of RNTC Section 24425? The second issue is, has appellant shown that the accuracy-related penalty should be abated? Appellant is the parent company for the 6th largest property and casualty insurer in the world. Under principles of unity, appellant, together with its subsidiaries, would be considered a single entity and combined into a combined reporting group for certain tax computations. For convenience, I will call the combined reporting group the combined group or the taxable group. Unity means the entities have such a close connection, they are treated as part of the same unitary business. Insurance companies are exempt from tax under Article 13, Section 28 of the California Constitution. Unity is relevant here because it shows a tax benefit from this insurance exemption. There is a difference between unitary group and combined group. Exempt organizations are part of the unitary group but are not included in the combined group. If you imagine a circle representing the unitary group, the combined group is a concentric circle within that circle. The combined group is just the taxable subsidiaries. Appellant had a unitary group, including many insurance subsidiaries, but a much smaller combined group. Again, as we'll see, there was a tax benefit in that all the insurance subsidiaries were removed from the combined group. As some indication of the size of appellant's unitary group, respondent has provided Exhibit G, which is copies of several National Association for Insurance Commissioners, NAIC forms, from some insurance subsidiaries. The forms had organizational charts with over 100 entities. I am now going to review some of the facts which suggest that appellant is unitary with the insurance subsidiaries. Appellant's 2011 annual review, like an SEC Form 10-K, which is our Exhibit A, had financial statements referring to the unitary group on a worldwide consolidated basis, including both the combined group and the insurance subsidiaries. The annual review had a summary of the year's operations on a worldwide consolidated basis, again, including the insurance subsidiaries. As far back as the 2003 annual review, the appellant referred to a single high-performance standard for its employees everywhere. When a person in any part or level of the company picks up the phone and says, "Liberty Mutual, how can I help you?" they both mean it and have the skills and technology to do it. Appellant uses a stylized depiction of the Statue of Liberty as its trademark. The worldwide headquarters for the group, including both the taxable group and the insurance subsidiaries, was in a single building, 175 Berkeley Street in Boston, but it has since moved to the eponymous Liberty Mutual Tower at 157 Berkeley Street. From 2003, appellant managed the Retirement Benefit Plan, the Employees Thrift Incentive Plan, the Supplemental Income at Retirement Plan, and the Medical, Dental, and Life Insurance Plans post-retirement, covering all U.S. employees of both the combined group and the insurance subsidiaries who met certain eligibility requirements. There were earnings calls where they discussed the entire business, and that's our Exhibit K. The combined group performed management services for the insurance subsidiaries under an intercompany management services agreement, which is our Exhibit I. The combined group performed various asset management services for the insurance subsidiaries, and that is on an SEC Form 13F filing, Exhibit L. And the loans are an example of intercompany financing, where the entire unitary group's credit was used to benefit members. On its 2011 California tax return, appellant reported approximately $5 billion in gross income for California purposes on a water's edge basis, which means limited to U.S. domestic entities, primarily from investment income. This was just the taxable combined group without the insurance subsidiaries. The 2011 annual review reported worldwide consolidated revenues of $34.7 billion, including the insurance subsidiaries. The NAIC statements reported approximately $17 billion of gross income from the domestic insurers listed. Both numbers are substantially higher than $5 billion. So billions of dollars of exempt income was removed from the combined report. We don't know the exact amount as it was unnecessary to report it. Now that we've discussed appellant's unitary group, we will move on to the loans. As mentioned, appellant borrowed funds and contributed the proceeds to insurance subsidiaries. Audit Division denied the interest expense deductions. As per briefing, the parties agree on the loans at issue. As an example, the 2007 offering memorandum, which is our Exhibit E, reports that the proceeds of the loans would be used for the insurance subsidiaries and describe the business as the premier property and casualty insurer. Further, the same document said that the ability of the insurance subsidiaries to issue dividends was limited as they needed approval from regulators. In the IDR 14 response, our Exhibit D, the auditor provided a list of loans to appellant and requested that appellant confirm the proceeds were contributed to insurance subsidiaries. In response, appellant confirmed each. We've discussed the background of the case, and we're now moving on to the argument. The Court of Appeal in Metropolis referred to the principle that deductions are a legislative grace and the taxpayer must prove entitlement to the deduction. Moreover, deductions are construed against the taxpayer. In Great Western Financial, the Supreme Court held that the taxpayer must prove that RNTC Section 24425 does not apply. Appellant has not shown that it is entitled to the interest expense deductions. The interest deductions are disallowed under RNTC Section 24425 because appellant borrowed funds and contributed them to exempt insurance subsidiaries. And I would ask you to look at our slide 1, but we have our printout. So RNTC Section 24425 states, no deduction shall be allowed for any amount otherwise allowable as a deduction, which is allocable to one or more classes of income not included in the measure of tax imposed by this part. I will now take a closer look at the allocation to one or more classes and not included in the measure of tax parts in order. First, we're looking at allocation. RNTC Section 24425 refers to a deduction allocable to one or more classes of income. The deduction is allocated to the income of the insurance subsidiaries. Alternatively, it could be allocated to the dividends appellant received from insurance subsidiaries with the same result. Allocation generally means an association between expense and income, an assignment based on a connection between different groups. The interpretation is not limited to a particular form of accounting, although cost accounting has a developed practice of assigning cost centers to business units. The allocation here is taking an expense and assigning it to a profit center. For example, the salary of financial analysts making investment decisions on purchasing taxable publicly traded stock. This expense would be assigned to taxable investing. It is not assigned to the operating income of the insurance subsidiaries. And we are considering the interest expense from loans which are contributed to the insurance subsidiaries in order to grow those businesses. Treasury Regulation Section 1.265-1C is a relevant source. Briefly, the regulation states expenses directly allocable to a class of exempt income shall be allocated thereto. If the expenses are indirectly allocable, the regulation requires using a reasonable proportion based on the facts and circumstances. Thus, RNTC Section 24425 contemplates a factual inquiry to trace direct expenses to a specific class of income. The factual inquiry has been described as finding a dominant purpose. In any case, a taxpayer must make an evidentiary showing before direct allocation to a taxable purpose. Indirect expenses are assigned by ratio. In Zenith, FTB used an indirect allocation, not direct. In Zenith, FTB did not identify which specific loan proceeds were used to buy which specific stock. In fact, the Zenith decision cited the offering brochure to the debenture that did not require the funds to be contributed to an insurance subsidiary. Here, in the present case, audit identified specific loan proceeds which were contributed to exempt subsidiaries based on the offering documents and other statements. In Exhibit D, appellant confirmed the assignment. Thus, the identified interest expense was directly allocable to the income of the insurance subsidiaries. In Zenith, except for 1 year, the taxpayer used direct tracing to assign the interest expense to a taxable activity. Here, appellant did no tracing, only respondent has traced. In that one exception year in Zenith, the taxpayer did not meet its burden of proof. Notably, in the final year, the taxpayer contributed some amount to an insurance subsidiary. In that year, FTB's ratio was used based on facts and circumstances, which is an indirect allocation. So Zenith confirms that respondent's tracing, a direct allocation, is appropriate here. The interest expense is allocated or assigned to the income from the insurance subsidiaries. Appellant claims that an allocation cannot be made to the income of the insurance subsidiaries. Appellant is not correct. The loans were used to contribute to the insurance subsidiaries. Unlike the taxpayers in Zenith and Great Western, appellant did not borrow the money specifically to acquire dividend-bearing stock. Appellant wanted to grow the business of the insurance subsidiaries. The allocation is the strongest, most persuasive connection between an expense and a class of income. Appellant has claimed respondent did not identify a reported case where the allocation is to the income of the insurance subsidiaries, as though this should disqualify the allocation. That is not material. Rather, appellant is unable to identify a situation where a taxpayer borrows money specifically to contribute to exempt subsidiaries, and the deduction is allowed. Instead, the precedent, such as Zenith, suggests that appellant must provide evidence to refute the direct allocation to non-taxable income, and then appellant must justify an allocation by ratio. Appellant also argues that respondent is shifting income to a different taxpayer. Appellant refers to dicta in Great Western. It is a fundamental premise of tax law that each taxpayer is accountable and taxable only upon its own income and may deduct only its own expenses allocable to the earnings of such income. Combined reporting is one identified exception to this principle. The Court of Appeals decision in Handlery opened by quoting this sentence. The Handlery decision was premised on interstate combined reporting being an exception. It took only a single year, as Great Western was issued in 1971 and Handlery was issued in 1972. Moreover, RNTC Section 25102 authorizes respondent to allocate income among different persons as though they were one person. And again, the present case involves a contribution to unitary subsidiaries. Summarizing allocation to class of income, appellant needed to show that the loan proceeds were used for a taxable purpose. Instead, respondent has specifically traced the funds to contributions used to grow the business of exempt subsidiaries. Now I will talk about included in the measure of tax, the next phrase in the statute. RNTC Section 24425 refers to the class of income as being not included in the measure of tax. Appellant claims that the income in question was included in the measure of tax. In other words, appellant claims that either the income of the insurance subsidiaries or the insurance dividends have already been taxed under the California corporate income tax. Neither of these claims are true. Appellant is the parent company to the sixth largest property and casualty insurer in the world. Appellant would have billions more in gross income if the insurance subsidiaries were taxable. We don't know the exact amount because it was unnecessary to report this information. Appellant claims that the class of income has to be to the insurance dividends, but also that the insurance dividends are included in the measure of tax. In both Zenith and Great Western, dividends subject to a dividends received deduction, a DRD, were not included in the measure of tax. So appellant is simply not correct that an item subject to a DRD is included in the measure of tax. In response, appellant claims that a deduction must be wholly deductible in order to not be included in the measure of tax. Thus, according to appellant, if the item is subject to an 85% deduction, it is included in the measure of tax. But if the DRD is 100%, it is not. This is also incorrect. The text simply says not included. There is no limitation. Great Western Financial explains that this means under any authority for any purpose. The principle of reading the statute against a deduction would suggest that there is not a limitation only for 100% deductions. Furthermore, appellant is improperly adding language from a different statute. The parallel federal statute, IRC Section 265A1, uses the phrase wholly exempt. RNTC Section 24425 does not use wholly exempt. Appellant assumes that RNTC Section 24425 must be read as though it also uses the phrase wholly exempt. Based on Commissioner v. Asphalt Products, the U.S. Supreme Court would say the language of the statute lacking the additional text is clear and leads to no other interpretation. It is impossible to further explain the statute without repeating its language. Furthermore, the insurance dividend statute, RNTC Section 24410, implies that RNTC Section 24425 ordinarily can apply to partial DRDs. The insurance dividend statute prevents RNTC Section 24425 from applying during a transition period. The DRD was 80% during this transition period. If RNTC Section 24425 did not apply to partial dividends, why would the legislature need to create a special exception to prevent RNTC Section 24425?
I'm sorry. Can you slow down just a little bit as you're
I'm sorry.
talking? Thank you.
Oh, the numbers? My bad. A lot of 24425s. Let's see. The DRD was 80% during this transition period. If RNTC Section 24425 did not apply to partial dividends, why would the legislature need to create a special exception to prevent RNTC Section 24425 from applying? Finally, if OTA finds the text ambiguous, Anaheim Union Water suggests that the interaction of two statutes might resolve the ambiguity. The legislature could have made the deduction limited to 85% or 100%. The legislature chose 85%, which is less than 100%. Did the legislature choose only 85% in order to enhance the deduction? The legislature did not intend, by limiting the deduction to 85%, for taxable companies to incur interest expense that they would have disallowed if the DRD was 100%. To summarize the application of the statutory language on included in the measure of tax, the income of the insurance subsidiaries is not included in the measure of tax because they are exempt. Likewise, the insurance dividends are not included in the measure of tax because they are subject to a DRD. Consequently, appellant has failed to show that RNTC Section 24425 does not apply to disallow the interest expense deductions. We have just discussed RNTC Section 24425 Subdivision A. Appellant claims that RNTC Section 24425 Subdivision B should apply instead, and this argument is not persuasive. Appellant's argument is based on California Code of Civil Procedure, Section 1859, which is a canon of construction that specific provisions govern general provisions where the provisions are inconsistent. And let me repeat that, where the provisions are inconsistent. Subdivision A and Subdivision B cannot be inconsistent. Both disallow a deduction. Two separate provisions can disallow a deduction, and that is not inconsistent. The provisions would be inconsistent if under the same circumstances, one granted a deduction and the other disallowed it. In that case, whichever was more specific would govern when the two were inconsistent. The fact that there can be no inconsistency between two disallowances is sufficient. Nevertheless, I will explain how Subdivision A and Subdivision B cover different situations and are complementary, not contradictory. Subdivision A looks at the allocation of an expense to a class of income. If the expense is for non-taxable income, the deduction is disallowed. Subdivision B looks at the income, not the expense. It applies to a different situation, essentially a general corporation borrowing from an insurance subsidiary, even if the borrowing is for a taxable purpose. I will go over a hypothetical to explain. Suppose a large general corporation has a captive insurer. The captive insurer is an exempt insurer. The captive insurer lends money to the corporation. The corporation uses the loan proceeds for its taxable business and deducts the interest expense. Subdivision A involves an allocation of expense to an item of income. The money was borrowed to spend on the taxable business. Thus, Subdivision A would not disallow this. Unlike Subdivision A, Subdivision B does not look to how the expense is allocated. Instead, it looks at whether the loan would generate income for the captive insurer if the insurer were not exempt. Appellant claims that only Subdivision B applies in the insurance context, yet as noted in the original briefing, RNTC Section 24410 Subdivision B5 holds that RNTC Section 24425 does not apply in a transition period, and it refers to dividend income in Subdivision A. Why prevent something from happening if it could never happen in the first place? Further, the legislature affixed a terminal date to the grace period on RNTC Section 24425, which suggests that section may apply once the grace period has elapsed. In sum, with respect to appellant's argument on RNTC Section 24425, Subdivision B, the legislature wanted to disallow deductions from this different situation in addition to the situations where deductions were already disallowed. And Subdivision B is irrelevant to the present case and is not inconsistent with Subdivision A. And moving on to Issue 2, I would have you look at the second slide, which is about the accuracy-related penalty. So the ARP was imposed because there was a substantial understatement of tax and a penalty has not shown the penalty should be abated. RNTC Section 19164 conforms to the relative IRC provisions, Internal Revenue Code. IRC Section 6662 and 6664 and the regulations promulgated thereunder. This is summarized in Appeals of Loving Investments. In both years, appellant paid under $10,000 with the return. The understatement after concessions is in the hundreds of thousands. Thus, the substantial understatement requirement is met. Appellant can reduce the penalty by the proportion attributable to an item if there is substantial authority for that treatment, if there is a reasonable basis with adequate disclosure, or if there is reasonable cause and good faith. And for disclosure, the Treasury regulations require disclosure on a Form 8275. Appellant did not meet substantial authority. There is no authority supporting the position that a taxpayer can borrow money and use it for an exempt purpose and take an interest deduction. In comparison, Zenith involved at least an allocation by ratio between taxable and non-taxable. The taxpayer did a direct allocation under IRC Section 265A and the Treasury regulations, identifying a taxable purpose and connecting the expense to the purpose. Appellant did not do that here. In Zenith, FTB did a reasonable fact-based allocation between taxable and non-taxable purposes. Appellant did not do that either. Appellant claims the funds were spent entirely on a taxable purpose, even though the offering documents for the loans stated they would be used for an exempt purpose. No authority supports this position. Appellant has not satisfied the requirements for a reasonable basis for the same reasons, and there is no authority supporting its filing position. Further, appellant also does not have adequate disclosure because there was no Form 8275. Appellant did not meet the good faith and reasonable cause standard because there was no disclosure. Additionally, appellant did not attempt to allocate between taxable and non-taxable purposes. Appellant has not found an example that supports classification that this is reasonable cause. Respondent made concessions to facilitate resolution of the case. For penalty abatement, we're looking at appellant's position at the time of filing. Respondent's good faith during the appeals process is irrelevant. In conclusion, with regard to issue 1, appellant borrowed funds expressly to contribute them to exempt insurance subsidiaries. Appellant has not established that it was entitled to a deduction that RNTC Section 24425 Subdivision A does not disallow the interest expense. For issue 2, appellant made a substantial understatement of tax, and appellant has not established grounds for abatement of the penalty. Thank you, and I'd be happy to answer any questions if you have any.
Thank you so much for your presentation. Let me turn to Judge Aiken. Any questions?
Judge Aiken speaking. I do have one question, and I plan to pose it to Franchise Tax Board, but then give appellant also an opportunity to respond as well. So, focusing this moment on the measure of tax question, and assuming for this question that the dividends are allocable, that the interest deduction is allocable to the dividends, is the 15% of the insurance dividend income that is not subject to that 85% dividend received deduction included in the measure of tax? If you need me to repeat anything, just let me know.
I follow. First, this wasn't briefed by the parties and it wasn't raised by appellant. We haven't fully explored this issue. I would point out that if you would actually look at the text of 24425, which is our slide 1 again, it says, no deduction shall be allowed for any amount, any amount. And there is the Presidential State Board of Equalization opinion in San Antonio Water Company, which disallowed for any amount. It did not allow the partial deduction.
Okay, thank you. And appellant, did you want to respond, and do you want me to repeat the question I had asked?
Thank you. We would like to respond, and we do not need to have the question repeated. I would refer the panel to Liberty Mutual's tax return, which is in evidence as Exhibits 3 and 4 for the 2 tax years at issue. The dividend income is clearly included in the computation of income as reflected on line 4 of Schedule F. That includes 100% of the dividend amount. While a portion was subject to an offsetting deduction, the remaining 15% is obviously not. And as we previously stated, included in the measure of tax does not look to post-deductions. It looks to how much was included in the original computation, as supported by the case of Rosemary, California Supreme Court case, and Green Investments, both interpreting the phrase included in the measure of tax to mean gross income.
Okay, thank you. That's my only question at this point.
Thank you. Let's turn to Judge Gass. Any questions?
This is Judge Gass. I'll wait till the end. Thank you.
All right. So now it's appellant's turn for its presentation. Appellant, are you ready to proceed with your rebuttal statements?
Yes, Your Honor, thank you. Can you all hear me okay?
Yes.
Great, thanks. As Attorney LaCava stated earlier, I think this is a fairly simple case that unfortunately has been complicated by hundreds of pages of briefs. But I think we get down to the core issue, and there's just a few things I'd like to point out in response to the things that have been said by respondent here today. I think the first thing is this is very clearly a simple question of, are the deductions that we're talking about allocable to a class of income that hasn't been subject to tax, right? It's very simple. It's all about the same taxpayer. Respondent would like us to believe that we need to walk across the aisle to someone that is not subject to the same tax to find a class of income that somehow has not been subject to tax. Respondent also paints an interesting picture, bringing us into the unitary business principle. I don't wish to take us there because it's a red herring and quite frankly it's irrelevant. Appellant has never contested the fact that we are engaged in a unitary business, and we have no intention to do so. However, respondent attempted to characterize the operations of our unitary business by saying things like, the insurance companies are not taxable. They're exempt from tax, I think was the phrase that was used. They're actually subject to a premium tax. There were also insinuations that billions of dollars of income were, I think, in quote, removed from the tax base. That was done by operation of law. The California taxation system requires that non-insurance companies file one set of returns while insurance companies file other sets of returns. So the taxpayer did no such thing as remove income from a tax return, right? So all of those insinuations and all of that, I think, speculation with respect to the unitary business principles are relevant here. As Ms. LaCava pointed out earlier, all of the authorities on point in this matter directly involve income and expenses of the same taxpayer. To suggest otherwise would lead down a path of absurdity that I just don't feel like taking us down. I think some of the other themes that we heard sort of suggested here today involve, again, the fact that a DRD, a partial DRD, somehow means that something is no longer subject to tax. The statutory language here, I think also, as pointed out by a respondent, is pretty black and white. Something is either included or it isn't. In this case, income is included, right? The only income to which those expenses can be allocated. So I just urge this panel to think about the simplicity, as I know you know, of this case. And when it comes to penalties, I think the important thing to remember is that it's an or test. And the statutory language is very much in favor, the plain meaning, actually, of the statutory language is very much in favor of appellant in this case. It is very clear that Liberty Mutual deducted expenses that are allocable to a class of income that is included in its tax base. That is what's required here, required by every single authority that's been cited in the briefs, and there has been no authority cited by the other side to the contrary. So thank you.
Thank you for your rebuttal statements. Let me turn it back now to Respondent Franchise Tax Board for rebuttal statements.
Thank you. So just to sort of summarize our position, appellant failed to establish that it was entitled to the interest expense deductions. As provided in Great Western, appellant had to show that RNTC Section 24425 does not disallow the deduction. The interest expense is allocated to the operating income of the insurance subsidiaries. The allocation is simply the most direct, persuasive connection between the expense and income. The allocation was made based on the evidence of the offering documents and appellant's agreement as to the use of the funds. The insurance subsidiaries were unitary, shared the same office building, appellant managed the retirement plans, and so on. That class of income is not included in the measure of tax because of the constitutional insurance exemption. Alternatively, the interest expense could be allocated to the insurance dividend income. That class of income is not included in the measure of tax because, like the dividends in Great Western and Zenith, they are subject to a DRD. Appellant's claims that they must be subject to a 100% deduction are not supported by statutory interpretation or context. Finally, appellant is subject to the ARP because of substantial understatement. Because appellant has not found any authority that permits interest expense deductions for amounts contributed to an exempt insurance subsidiary, appellant has not found authority to abate the penalty. Nor did appellant properly disclose the position on a Form 8275. And in regards to appellant's claims that the income of the insurance subsidiaries was included in the measure of tax, I would point to, on our slide 1, the text of RNTC Section 24425, which limits, it's not included in the measure of the tax imposed by this part. And the tax on insurance companies is not imposed by this part. So in sum, OTA should find for respondent on both issues. And that's all I have.
Thank you for your statements. Let's finally turn back to appellants for his closing statements. You have 5 minutes.
My microphone, how about I'll do that, and then that will be, yes.
That's helpful.
We've had enough technology issues today, right? Again, I think, just to keep this as simple as possible, the issue here is whether Liberty Mutual was entitled to take deductions of interest expenses. The only class of income to which they can be attributable, because it has to be Liberty Mutual's income, right, is the dividend income that it received from its insurance subsidiaries. I think appellant understands that we bear the burden of proof in this case. Again, I don't think there's a question on that. I don't think appellant disputes the fact that we are part of a unitary business with our insurance subsidiaries. The fact of the matter is we borrowed money, right? No one has denied that fact. The money was contributed to insurance subsidiaries. No one's denied that fact, right? The question really just is there income in the measure of tax to which those expenses can be attributed? And it very clearly is within the measure of tax. All of the precedential authorities in California all say, right, that something is included in the measure of tax if a portion of it is included in the measure of tax. And quite frankly, this board has recently concluded the same. So thank you.
Thank you so much for your closing statement. Let me turn to the panel one last time for any final questions. Judge Aiken, any final questions for either party?
No additional questions from me, but I did want to thank both parties for their time today and for bearing with us with some of our technical difficulties. So thank you.
Judge Gass, any final questions for either party?
Yeah, I have a few questions. They'll be brief, hopefully. This one's for appellants. So RNT section 244110B5 says that 24425 doesn't apply for certain years, and it makes no reference to that section for other years. So can't you infer that it does apply for these years because it doesn't apply for certain years you make an election?
So, I think the first thing that I'd point out is that the legislative history actually expressly states we are to make no inference with respect to that provision. And I think what's really important is to sort of set the stage as to what was going on at the time that legislation was enacted. So it was right after the Ceridian case was decided, right, which essentially held that dividends that were previously allowed at 100% for insurance companies, and again, it was because the insurance companies were based in California, so there were some forward commerce clause issues in there, right? It was held to be unconstitutional. And in response, of course, right, there's a lot of chaos with respect to those taxpayers that had taken a dividends received deduction, those taxpayers that didn't take a dividends received deduction. So legislation was enacted that essentially said everybody gets 80%, okay? But when we think about everybody having 80%, right, we have to think about it against the backdrop of who was taking what and when, right? So we had, I'll call them A and B. We'll keep this as simple as I possibly can, and I promise I'm going to talk very slow because I tend not to. So we'll call it taxpayer group A. So taxpayer group A, we'll say, are those folks that originally had taken 100% dividends received deduction. The legislative history very clearly also states that those folks, right, that the FDB had disallowed expenses under 24425, and sort of, again, so very clearly says that. And it says, listen, we've got to fix it for those folks because now they're going to have an 80% DRD, and they're going to be up against the folks in the past, right, that had not had to deal with 24425 because they took no dividends in the first place. Right? So I think the legislature very clearly felt, and the language is pretty clear, that they were there for the folks in column A, right? Again, to put them on the same playing field that the folks in column B were in, and that we should therefore draw no inference post, right? Because there was nothing to be cured post that point, because it was very clear, based on the authorities that would have existed at the time, that a partial DRD would have been includable in the measure of tax. And then additionally, of course, right, 24425 was further amended, adding subsection B, right, that dealt specifically with insurance companies. So I think the legislature was also hesitant to make additional statements with respect to 24425A in that industry as well. So thank you.
Thank you for that. And then real quickly for the Franchise Tax Board, going to the allocable to one or more classes of income. In Great Western, the subsidiary was taxed on its income out of which the dividends were paid. So how does that support your theory that the expenses here should be disallowed. Because in that case, the subsidiary was taxed. In this case, it wasn't, and you're saying the subsidiary needs to be taxed? Yeah, because you're saying the insurance subsidiary is exempt on the income under the gross premiums tax, but here in Great Western it was taxed, but the expenses were denied to the parent. Still, is there a distinguishing thing to that, or?
For it's a little bit unclear because I think the question is whether or not it's an allocation to a class of income, and you're looking at what is the expense and then what is the class of income it's being allocated to, and so based on the evidence, we're saying the expense is most likely allocated to the class of income of the insurance subsidiaries. Now, that income is not included in the measure of tax, and if the income was included in the measure of tax in Great Western, then that just, I mean, it's even more. For Great Western, they looked at the dividends, not the income of the operating of the subsidiary. So I guess one way to distinguish them is that that's looking at the dividend, right? And it doesn't matter what, like the case in Great Western said, when you're just looking at the dividend, it doesn't matter whether or not it was taxed or not by the subsidiary, by the company issuing the dividend.
Okay, thank you. No further questions.
Thank you, everyone. If there is nothing else, I think that will conclude our hearing. Thank you, everyone, for coming in today. This case is submitted on February 12th, 2026. The judges will meet and decide this case later on, and we will send you a written opinion of our decision within 100 days. Today's hearing in the appeal of Liberty Mutual Group, Inc. is now concluded, and we are off the record. This concludes all of our oral hearing matters for today. Thank you, and goodbye.